All right. Today is Thursday, November 17th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight, and let's start with the most urgent and most critical financial news, the Taylor Swift scandal. You see, they keep saying, hey, inflation is going down, the demand is being crushed in the economy, and the Fed must stop and pause their campaign of interest rate hikes. Meanwhile, we have over 14 million people stampeding to buy Taylor Swift tickets for the upcoming tour. And of course, Ticketmaster website crashed, and only a lucky 2 million people managed to buy their tickets. Now, this could be the most profitable musical tour in history. And Taylor Swift is about to make a billion, gazillion, trillion dollars from all of this. And people have been waiting in line, frustrating, 5 hours, no luck. 8 hours, nothing. 12 hours, while holding their piss, which was a delight to the eyes of Jeff Bezos. And people are mad. They say it was supposed to be birthday presents. They're supposed to be Christmas presents. But we couldn't get the tickets. And now, of course, your beloved politicians are doing something about it. They're now investigating the monopoly of Ticketmaster. All of a sudden, when their spoiled brat daughters can't get their Taylor Swift tickets, the politicians are getting up to work. And look, I don't have any daughters, knock wood, but I know a lot of folks who do. The last thing that dads want to deal with is the wrath of their daughters. Even though these tickets are costing $10,000, $20,000, $50,000 for average seats. But it doesn't matter. To avoid the wrath of your daughter, you're paying $100,000, $1 million, doesn't matter. What are you, a loser, dad? Should I get a new daddy? No wonder why you see all of these dorky dads getting manhandled by their daughters and wives. And of course, that explains the crash. Forget about the crash in the stock market. It's the crash in male fertility. That's the real deal. With the lead in the water and all that stuff, look at your average man these days. Same hairstyle, same stupid beard, same stupid vocabulary, no flavor at all. And no wonder why sperm counts got cut by half since the 1970s. Matter of fact, give us a live look for the ticker SPRM. Let's see how it looks. And ooh, look at this. Down to zero. We should have bought put options on the ticker SPRM. But hey, it's a missed opportunity. But you know what? We might have other opportunities to buy put options on, because today we got sort of a glimpse of a reversal. The VIX was slightly up, the dollar was slightly up, yields went slightly up, but we see this battle where the market's still fighting the Fed. We see this battle, the internal battle of the stock market, moving from one theme to the other day by day. Yesterday was a recession theme. Today we're back to the soft landing theme. And yesterday was the Fed pivot theme, and the one before it was inflation theme. And the market is now confused all over the place. And you know what happens when the market is confused? The best thing you can do is raise as much cash as you can and step out of the way. Let the market find out which direction it wants to settle in, and then we step in. Otherwise, it's a pie factory out there. And today's action was a reminder of that. The market opened gapping down in the morning big time, only to reverse and close pretty much in the flat line. I'm going to talk about this and a lot more in tonight's program. But before we do that, how about we start with the main topic of tonight's video. And here it is. In focus tonight. Higher, baby. This is at least according to your boy James Bullard from the St. Louis Fed, who happens to be our favorite Fed president of all time, because he has the tendency of smoking certain substances and then issuing blunt statements that sometimes move the market erratically. We got a taste of that today. So what was the big fuss all about? What did Bullard say to crash the market? And everybody was up in arms. Bullard should shut up. All what Bullard said is that the Fed may, it's an important keyword, have to raise its benchmark interest rate much higher. Another keyword, much higher than it has previously projected to get inflation under control. How dare you, Mr. Bullard? How dare you kill my calls? What he said is that the Fed funds rate could be between 5 to 7%. And this is up from the current range that the market is pricing in. 3.75 to 4%, so much higher. And of course, Mr. Bullard warned that if the Fed thinks about raising its inflation target higher, that would sow chaos globally. So higher rates, not higher inflation target. And people are so pissed off, even though what Bullard said is, hey, look, the policy rate is behind the curve. We should have raised interest rates back in July 21, but we're catching up. In the generous Taylor type rule, projection, the Fed interest rate will move all the way to 5%, which is the consensus of this program. The minimum should be 5%. And then we're talking. But of course, Bullard said, and you have to give scenarios here. You can't just say, hey, 5% and that's it. What if we have to go higher? And if that is the case, using the less generous Taylor type rule, the interest rate could move as high as north of 7%. And immediately, the talking heads on Wall Street were exploding. Take a look.
Which it doesn't yet, but there's signs that it's coming down. There's pretty good signs that inflation is coming down. I'll get to that in a second. There's jawboning and then there's taking it too far. The 7% number is just simply unnecessary. You know, you can say we're probably going above 5%. You could be Mary Daly and say rationally a pause is not even on the discussion table. But 7% is inflammatory and unnecessary.
Let's keep in mind, Bullard is not a voting member next year. So December is his last rodeo. I don't know why he felt compelled to make a statement of the sort that he's made. It doesn't seem to be terribly productive at this point. I don't think the Fed should be focused on knocking stock prices down on a daily basis. We had a lot of Fed speak today, but this one I agree with Jim. It's a little bit over the line, and his opinions are not even going to factor into what they start doing in the first quarter regardless. He should probably be doing his private equity firm job interviews at this point and not saying things like that. The market is seeing right through it.
And we know why they're pissed off, because Bullard kind of spoiled their little Ponzi scheme party. You see, they're pissed off because their bonuses are down by as much as 45% this year. And this is the pimping season. You got the last quarter of the year. Either you're going to score bonuses or not. And the way they can score bonuses is by pumping your money that you trust them with to pump the market higher, artificially of course, and score those bonuses, and then whatever happens to your money, who cares? The bonuses are secured, baby. And here's the problem. Here's why the Fed comes out with the hawkish rhetoric. Because the market continues to fight the Fed. And every time the market continues to fight the Fed, financial conditions loosen. And if financial conditions loosen, inflation will move higher again. And this is what the Fed is trying to prevent. And they can do that the easy way by scaring the market rally and say, hey, watch out, we're not going to pivot, we're going to go higher. But if the market continues to fight them and say, la 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 la, I can't hear you, whatever you say, Bullard, it doesn't matter. Whatever Jerome Powell says, it doesn't matter. We want to go higher because we decided to. Therefore, we call it the zombie rally. No brain, no critical thinking at all. When they do that, then the Fed has to act because the talk, the warnings, they're not effective anymore. So now comes the time for action, meaning the Fed will have to raise interest rates higher and no 50 basis points in December. It's going to be 75. And Jerome Powell will come out hawkish as you know what, and then the market goes down. But there is a risk to that because at this point, the Fed should ease the rate of interest rate hikes. But this is only contingent on two things, the market and the consumer collaborating with the Fed. If they continue to fight the Fed, then the Fed will have no other choice but to continue to raise interest rates higher, perhaps at a faster pace, to make sure that financial conditions are not going to loosen too much. And there is a massive risk to doing that. This fight against the Fed will drag the economy into an apocalypse. Keep that thought in mind because we're going to revisit it in a minute. But all of these crooks in Wall Street better hope that the Fed finishes the fight against inflation as soon as possible. And by fighting the Fed, they're dragging this fight for longer. And here's the problem. The participation of retail traders and investors was good for these money managers. They pumped the market higher. But now, the same cohort of mom-and-pop investors have to take money out of the market to fight inflation in real life, to buy groceries, to pay for gas, for utility bills, for debt, for housing. And this will add downward pressure on stocks. You're not going to have the support and the participation of mom-and-pop investors. So you better step out of the way, have the Fed get the job done, kill inflation as soon as possible so we can survive with minimal damage, or we can have the participation of retail mom-and-pop investors back in the stock market. But the longer this fight drags on, the more damage we're going to see in the real economy by inflation dragging on, and the more damage we're going to see in the stock market because more money will come out to fight inflation in real life. But of course, the geniuses on Wall Street, they don't understand any of this. They're brainless zombies who want to pump the stock market higher at any cost. It doesn't matter. Just give us the bonuses, damn it. No critical thinking of what's going to happen next year and the long-term trajectory. It's all about now and here. They want to make their bonuses and that's it. And I say the crybabies on CNBC need to admit that they have a bias to pump the stock market higher and they don't care about inflation. Bullard is right. So long as the tailwinds of inflation are intact, it will pop higher. The moment the Fed relaxes, rates must go above the rate of inflation. Every inflation episode in history ended in one of two ways. Number one, a financial accident that blew up the system and inflation went down with it because a financial accident is deflationary. Case in point, 2008, 2009. Or the monetary policy successfully defeated inflation. We have this example back in the 1980s with Paul Volcker. And the way he achieved that is by raising interest rates above the rate of inflation. So when Bullard says maybe the rate should go as high as 7%, is he really that crazy? Or is he basing this assessment based on what happened in history and how the Fed in the past defeated inflation? But of course, none of this matter for these zombies, be it the talking heads on Wall Street or the talking heads in DC. For example, Elizabeth Warren, who's supposed to be a champion for the middle class against Wall Street. This time around, she's siding with the fat cats, and she says the Fed is risking pushing our economy off a cliff. There is a big difference between landing a plane and crashing a plane. Now, Senator, I got some news for you. The plane is going to crash either way because they're too late in the fight to begin with, which means the economy is going to weaken, inflation is going to stick, and they're going to have to raise interest rates higher regardless, and the plane is going to crash. The soft landing is a fantasy. So if you suggest that the Fed has to pause right now because inflation is already going down a tick, and that's it, they have to stop, I say people who are calling for the Fed to pause rate hikes because inflation went down a tick are the same people who head back to the buffet to celebrate losing 1 pound. What happens when you do that? You gain 5 pounds instead. And this is exactly what's going to happen in this inflation episode. For example, we have dickhead King Griffin, who says inflation is trending down, but halting interest rate hikes would be the worst mistake that the Fed could possibly make. And you know what? He's right. Because if the Fed loosened the policy right now, or if the market continues to fight the Fed, the end result is the same: loosening of financial conditions. For example, so far, the market rally that we got so far, and the pullback in bond yields. The impact of this is mortgage rates dropped by the largest amount in 41 years. Now, this will ignite the aggregate demand because folks still have their jobs, their inflated wages, they're waiting in line. The tailwinds for inflation are still here. And the moment mortgage rates go down, the demand will kick back in. And here we go, we have yet another stampede because folks want to lock in these rates before they go higher again. And in doing so, inflation will move higher. Financial conditions are going to loosen, and then the Fed will have to come back and be even more aggressive in raising interest rates. For example, if before financial conditions loosened, let's say hypothetically speaking, it would have taken the Fed interest rates to go all the way as high as 6% to tackle inflation down. Now, after financial conditions loosen, this rate will go all the way up to 7%, then 8%. And then 9%. Whether the Fed sends the wrong signal by pausing or by hinting that they're about to pivot, whatever that word means, or by the market fighting the Fed, the end result is the same: loosening financial conditions, which will lead to higher interest rates ultimately. What is the risk in doing that? Now we're going back to the conversation when I told you hold that thought. Look at what's going on in the yield curve right now. The current inversion of the yield curve exceeds the Thing recession in 2020, the housing bust back in 2008, the Gulf War back in the 1990s, and so long as this stupid fight continues to drag on, be it the Fed sending the wrong message or the market fighting the Fed, the more inverted the yield curve will become. In other words, the higher interest rates will go and the deeper the recession will become, because the inversion of the yield curve is the most accurate and reliable indicator for a recession. Every single time the yield curve has inverted, we got a recession in the economy the year after. And perhaps this is a headline that you will see in the United States soon if this stupid fight drags on. Look at what's going on in the UK. They're already in a recession right now, and the fiscal policy will have to be impacted by cutting spending, so no more benefits to you, and oh, by the way, more tax hikes. Get the hell out of the way, stop fighting the Fed, and let them do their job. The sooner they're finished with the job, the less damage will happen to the economy, and the sooner we can move on. But if the Fed becomes callous about the degree of inflation, and they get excited by one report, and they start to pivot and send the wrong signals, or if the stupid market continues to fight the Fed and loosen financial conditions either way, the deeper the hole the economy is going to be in. And the recession that was supposed to be maybe mild now becomes a really deep recession. And therefore, JP Morgan, for example, says that the U.S. economy will tip into a mild, quote-unquote, recession next year as the Fed winds down rate hikes. But a hard landing could be coming, so it could be either way. You're on the plane right now, it could land or it could crash. Either way, buckle up your seatbelts and eat your peanuts. It could be your last meal. And then you got Chicago Fed Evans, who possibly the most dovish Fed member right now. He says inflation can fall quickly with soft landing and no recession.
I believe I can fly.
So now you get these morons. The market fighting the Fed, the consumer fighting the Fed, and some stupid doves in the Fed also doing this mistake, which will get us at the end in a deeper hole. You got the Philly Fed President Harker, who now says, hey, the interest rates that we got right now, they're sufficiently restrictive. And I say, Mr. Harker, sufficiently restrictive as in, look at what's going on in the credit card mania. That's restrictive to you? Consumers are spending like it's 1929, swiping those credit cards up and down, up and down, up and down, with no mercy at all. This is restrictive to you? No. The interest rate has to go higher and higher and higher. Believe it or not, James Bullard happened to be one of the most sane members in the Fed right now, which maybe we have 2 of them. Maybe 3, and that's it. The rest, they don't give a shit. They're all insider traders anyway. They want the market to go higher so they can make their money and then they retire and get a hedge fund job. You know the deal. Crooked, corrupt assholes. This is why the economy is going to head into a depression. And of course, there is another side to the fight against the Fed. It's not just the zombified stock market. It's not the dovish members in the Fed, but it's also the consumer fighting the Fed by swiping those credit cards up and down, up and down, up and down. And instead, they should listen to Dr. Evil, Jeff Bezos, who says, hold on your big ticket purchases right now. Stop pushing inflation higher. Stop stampeding. Let the Fed do the job, and you're going to get all of these big ticket items for pennies on the dollar. You morons. But so long as you continue to stampede, prices will continue to stay higher and higher and higher. And look, the sooner you understand this and you accept it, the easier your life is going to become as an investor. The Fed cannot stop. They cannot pivot. We talked about that ad nauseum. The moment they stop, inflation will pop higher again. The moment they soften the rhetoric, the market will get the wrong signal and rally higher, loosening financial conditions. And here comes inflation popping higher again, the Fed having to raise interest rates even higher to tackle inflation down. So the only reason right now for any Fed pivot will be, number 1, a recession, mass layoffs. The moment we get a really horrific employment report, that's the moment when the Fed is going to pivot. But at that point, the economy is going to be in a recession. This is exactly what Citibank says. The Fed will only stop tightening if there is a recession. And investors are stretching if they're hoping for a pivot right now. You think a recession is a good entry point for the stock market? I know what you're going to say. Oh, what about 2009? It was a good entry point. The economy was in a recession, but this was back when the Fed initiated quantitative easing. Print, baby, print. And bailouts all over the place. This time around, they cannot afford to do that because of inflation. The other reason for a Fed pivot would be financial risk. Something blowing up. And we're not just talking about FTX. We're talking about something bigger than that. Even the king of the doves, New York Fed Williams, says that the Fed should stay focused on tackling inflation and stop even thinking about financial risk right now. That's a distraction. That's going to happen either way. That's the cost of reducing inflation. That's the cost of fixing the Fed's mess to begin with. A recession and financial risk, meaning something or some things blowing up. Then the Fed is going to pivot. And with that out of the way, let's move on to cover the stock market information for you. And we begin with the closing of the indices today. And here we go. The Dow Industrial Average in the red, down by 7.51 points or a decline of 0.02%. The Nasdaq down by 38.70 points or a decline of 0.35%. The S&P also down by 12.23 points or a decline of 0.31%. When it comes to the sectors' performances today, pathetic across the board, mostly in the red, with tech and defensives barely in the green, so we're not going to give any medals today. But at number 1 was technology, number 2 defensives, number 3 energy, and the laggard of the day was the winner from yesterday, utilities, down big for the day. And this is what I say, folks. Yesterday, the market was buying the ultra defensives because it was a recession theme. Today, it was a recession theme in the beginning, and then it became a risk-on theme once again. The market is confused. You don't want to jump in right now. What you want to do is step back, raise as much cash as you can until more clarity, until the market makes up its own mind. On to the advance to decline ratios. NYSE 35% advancing versus 63% declining. The Nasdaq 36% advancing versus 61% declining. When it comes to commodities, ugly day across the board. The reason is the dollar was much higher, at least in the morning, and then it came down a little bit as the market rallied higher. And you should have listened to my warning last night because oil is down big. And I hope that at least some of you used my hedging strategy, selling upside calls and using some of that money to finance buying puts, aka insurance. Now, while futures were down big in energy, the majority of energy stocks were actually higher for the day. So you got your opportunity today to use the insurance policy and hedge. Anyhow, the WTI was down over 4.25% for the day. Brent was down over 3% for the day. Gasoline RBOB down by almost 2% for the day. Heating oil down by a little over 2.25%. On the other hand, the party boy, natural gas, scoring gains of almost 3.25%. When it comes to softs, the only bright light is lumber futures with gains of almost 2.5%. The rest in the red, down big, led by coffee. The massacre in coffee continues with yet another down day worth about 4%. And then we have sugar down almost 3% for the day. Cotton, cocoa, all down by almost 2%, then OJ down by a little under half a percentage point. When it comes to metals, the dollar is up, metals down. Look at this. The reaction in commodities is appropriate. The dollar moves higher, the rally in commodities goes down, a pullback at least. But the stock market reacted in a different way. Initially, it acted appropriately by moving down as the dollar rebounded higher. But then came the fighting the Fed mentality, fighting the logic mentality, the zombie rally, and equities moved higher. But commodities suggesting that we should move down. You got gold down, silver down, platinum down, copper down, palladium down. Everything is down. When it comes to meats, the reaction is a little bit muted for lean hogs, be it on the downside by about half a percentage point. Yet live and feeder cattle futures both in the green, and the gains were led by feeder cattle with about 1.4% worth of gains today. When it comes to grains, mostly down, and the losses were led by canola down almost 2.5%. Likewise, soybean oil down almost 2.5%. Wheat down a little over 1.25%. Soybeans, soybean meal, oats all down for the day. Corn and rough rice barely in the green, be it closer to the flat line. On to the big casino, the options market. What's going on here? Notice yesterday it was a recessionary theme. The bets on the market, at least in the options market, were mostly negative, mostly buying puts. Today we're seeing the opposite picture. Mostly buying calls, and the market continues to flip-flop from one side to the other. Dangerous environment to be in. Lots of pies are going to be served, so why not step back, raise as much cash as you can, and prepare for the next big move. But for now, the hottest table by far. At number 1, Tesla, the souffle, at around 2 million contracts traded today. About 55% of those were calls. And at number 2, Apple, with around 1.3 million contracts traded today. About 54% of those were calls. Amazon at number 3, with around 1 million contracts traded today. About 62.5% of those were calls. On to the unusual activities that took place in the options market today. We begin with the ticker SNAP Snapchat. Somebody sees more downside for the name and they bought the 9.5 puts for the expiration date, December 30, with expectations that the name could move down and lose more than 13% of its value by then. They paid around half a buck a piece to enter this trade, all in all, spending around $600,000. And then what about the ticker BABA Alibaba? Lots of short covering in this name, and unfortunately, the mom and pops get sucked in, but it's only rising for a mechanical reason. Sooner or later, you're going to get bad news from China and the name goes down again. So be careful here. If you make a quick buck here, in, out, hello, goodbye. Always be closing. But somebody sees more upside coming for Alibaba, and they bought the 100 calls for the expiration date, December 2nd, with expectations that the name could blast higher and score gains worth more than 19% by then. They paid around $1 a piece to enter this trade, all in all, spending around $1.2 million. And then what about the SPY, the S&P 500? Somebody sees downside coming here, or at least they're hedging against it. They bought the 355 puts for the expiration date, December 14th, with expectations that the name could move down and lose more than 10% of its value. At least by then, they paid around $1 a piece to enter this trade, all in all, spending around $700,000. And lastly, at the bottom of the table, what about the ticker TSLA, Tesla, the souffle? Somebody sees more downside coming, the name is melting down, and somebody sees more downside coming here. They bought the 172.5 puts for the expiration date, November 25th, with expectations that the name could move down and lose more than 6% of its value by then. They paid around $2.40 a piece to enter this trade, all in all spending around $1.5 million. On to the heat map analysis. What's going on here? Look, regardless of the confusion, the flip-flopping by the market, one day it's risk on, the other day it's risk off, one day it's a recession theme, utilities move higher, the other day it's, pivot optimism and tech moves higher, the next day it's inflation kind of theme and we see oil and materials moving higher. But the consistent theme in all of this is healthcare continues to move higher. Specifically, the old school big pharma names, they continue to quietly gain. Merck, Eli Lilly, Amgen, you know the deal. So these are good names to park some money in if you must park something in. I say why not just get out and raise as much cash as you can. But if you must park the money somewhere, then these old school big pharma names are a good place to park the cash in. But look at what happened today. Just to illustrate for you the pump that took place in the morning, or by midday I should say. Around 9 o'clock, noon Eastern, we got the massive pump. The PPT plunge protection team intervened and pushed the market higher. And the easiest way you can do that is by pumping one name. And this one name happens to be the heaviest of heavyweights in the stock market, Apple. The big kahuna. If you can pump this one higher, you're going to muff the shot against the market. You're going to see the Qs holding ground, the SPY holding ground, because Apple has the highest weighting. So notice that today, to rescue the market, they could not buy everything because Amazon was down big, Tesla was down big, Microsoft initially was down big, software was down big, even the classic down names such as Disney was down big. But the easiest way you can do this is using call options on Apple, and the algos, the robots, the dealer will do the job by hedging, aka gamma squeeze. We see Apple moving higher, and Apple managed to close in the green, even though Google was in the red. Meta in the red, Microsoft in the red, Amazon in the red, Tesla in the red. So what's the deal with Apple? Here it is. In pumping the market, they decided to buy the 150, 152.5, and 155 calls with the expiration date of this Friday on Apple with massive volume. What they do is they get in and they get out. They're not even holding these call options. But in doing that behavior, the dealer gets the signal to elicit a gamma squeeze. The dealer says, oh, something is going on here. Why are they buying upside calls out of the money, 150, 155? Maybe they're seeing something here, and I gotta hedge and buy the underlying stock. Apple moves higher, and what do you know, all of a sudden the Qs stop going down, and it moves higher, along with the SPY. Mission accomplished. How long can they continue to play this game? Because look, the sentiment is in the trash. The mom and pop investors, they're not getting fooled by this rally. They're saying no thanks, a hard pass on buying the dip here. Guys like me are actually using the opportunity to raise more cash, dumping a lot of stocks that I hold in my portfolio, a lot of the options that I hold, taking the cash, stepping on the sidelines to do what? Waiting for the next big short, which is coming soon. And speaking of the big short, Michael Burry says, you have no idea how short I am. Now you could say, hey, Michael Burry is going to eat a pie in the face. He's all about the FUD, yada. Yada yada. I say between the big short and the big diaper, I'll go with the big short. For one thing, look at Disney, for example. Everybody says peak inflation. Inflation is gone. It's over. The good professor from Wharton says inflation is over. It's done. Officially done. Gone. It's over. Bye-bye. Meanwhile, Disney is raising prices for the second time this year. $189 a pop. So in case you cannot buy your daughter Taylor Swift tickets at $25,000 a pop, maybe you want to buy her Disneyland tickets instead. I'm just trying here to save you from your own daughter's wrath. Of course, she's not interested in Disneyland. She wants to go to Taylor Swift and hang around with the boys, and you know the deal. Next thing you know, hey daddy, I got a surprise for you. Not for me. Then we got news from Toyota, and every genius company out there is all in the EV mania. We know with the scarcity of raw materials, the costs for these batteries and aluminum and copper and all of that are skyrocketing. In other words, the companies that decided to go all in the EV mania, they're not going to be profitable for a long time. Mary Barra from GM says 2025. That's the year when we're going to be profitable. And when Mary Barra says 2025, it's actually 2027. On the other hand, smart companies that did not go all in the EV mania and decided to keep hybrid cars, which is, by the way, a tragedy, the biggest tragedy ever, getting rid of hybrid cars. They were getting better, fuel efficient, little batteries, not a lot of demand on these gigantic batteries, which pushed prices higher and created inflation and shortage of supplies. We did not need any of that had the automobile manufacturers transitioned gradually. Concentrate on the hybrid cars, get them better, and then transition to EVs gradually. But no, they're all in because, anyways, I don't want to get into it. Let's move on to the heat map for the ETFs. Muted reaction to negative across the board. Yesterday was a recession theme. XLU was leading the gains. Now the XLU is leading the declines. What's leading the gains? Nothing really. No notable reaction here that says, hey, one way or the other, this is a so-and-so theme. But we see the Chinese ETFs outperforming. That is risk on. Yesterday they were down big. Risk off. So again, step out of the way. Let the market make up its own mind. In the meantime, let's move on to charts, and we begin with the SPY, the S&P 500 30 minutes chart. What's going on here? We got the bear flag playing out, and it got us all the way down to 391. And the SPY found some footing here and rallied higher. And it closed the day above 391 and above 393.16. The bulls fought back. The aggregate demand kicked in after the dip. These geniuses want to get the market higher at any cost right now. They're not scared enough. So somebody from the Fed has to come out with more aggression. And a lot of you say, hey, Maverick, when bear market rally end? And I say, when you buy, that's when the bear market's going to end. So somebody, for the love of God, please, tomorrow buy some calls here and end this stupidity. Sacrifice for the rest of us. But look at what's going on here. We have the gap. The gap has yet to be closed. We have higher highs in the SPY. We have a trend line right now. So who's in charge? The bulls are in charge now. If they lose 391, then we could say comfortably that the bears fought back and the bears won again. The bears are adding more pressure on the bulls. And ultimately, the bears are going to win if the bulls lose 385.15 as support. But for now, the bulls fought back and the bulls gained the advantage. But before you get excited, look at this, the daily chart for the SPY's continuous contract. Again, consolidating in a bull flag pattern, waiting and waiting for the next catalyst to pop higher. But the problem is, it is running out of time. See, the chart right now is asking for buyers. Any buyers? Any buyers? Nobody's interested here. We got an answer today when the market went down. We got some interest, some buying, and the market ended up closing at the highs of the day. But is it enough to push this bull flag and play it out? For now, we know that the volume is pathetic on the buying side, which is bullish, by the way, but we're not going to see conviction until we see the volume moving higher on a buying day. For now, if the volume creeps back in, it's going to come back on the selling side. So the bulls are running out of time. They better play out this bull flag as soon as possible. Otherwise, they're going to lose momentum. The RSI is going to start to curl its way down. The MACD will do the same. And sooner or later, we're going to see a flush down all the way to 3,855. And then the bull flag goes out of the window. The bears are going to be encouraged now to bet against the SPY. Next thing you know, it loses 3,855. And down we go all the way to 3,720.5. And little by little, the bear market goes bye-bye. But for now, the bears are waiting and holding strategically, of course. They're waiting for what? If we look at the daily chart for the SPX, the cash index, look at what happened today. We got a rebound from what? You see that blue line? That is the 100 days moving average. We caught support, and it has been acting as good support and good resistance for a while. But there is another thing that the bears are waiting for, which is the 200 days moving average. And this is about 3% or so above where the chart is trading right now. And the bears are waiting for the 200 days moving average because they believe this will be the resistance where the bear market rally is going to end. We'll see what happens. But this is what I'm watching for, at least for now. The Qs, 30 minutes chart, what's going on here? The bear flag played out and the chart lost 284.26, only to climb it by the end of the day. So is this behavior bearish or bullish? The answer is, it is bullish. It started down, a gap, but then the demand kicked in, more buying, and they managed to close the chart at the highs of the day. For now, the bulls did show up, and therefore I continue to say for the bears, be careful from rushing into betting against this rally right now. We have yet to get a confirmation. We got some signs, some initial signs that the reversal is around the corner, but we have yet to get the confirmation. Because what if this is a pattern of higher lows and higher highs? We have yet to see the higher highs, but this is what the bulls are aiming for. When we look at the daily chart for the continuous contract for the Qs, again, consolidation in a bull flag pattern. The chart did not even lose the support of 11,689. The assumption for now is the bull flag will play out, but the bulls are running out of time. They better get it done by the end of the week. Otherwise, the bears are going to smell some weakness here. They're going to say, you know what, forget about waiting all the way to the 200 days moving average in the SPX. Let's do it right now. We're seeing the reversal happening right now. The SPY lost key support. The Qs lost key support. The buyers are getting exhausted now. they're running out of gas. So the bears are lurking. They're waiting. And I'd like to be one of them. I'd like to step aside, raise as much cash as I can, and wait for the next move. When we zoom in to the same chart, let's use a 30 minutes chart. Look at this. We have a reverse ABC pattern, got us all the way down to the support, followed by bear flag consolidation pattern, which played out, got us below the support line. But today we got a reclimb of the support line and a closing above it. The bears would look at this and say, hey, it doesn't matter. Look at this. This is a bear flag consolidation pattern. Sooner or later, down we go. The bulls fight back and say, not so fast. The pattern is making higher lows. Yes, we have some resistance here in the sloping line, but sooner or later, we'll find the buyers or we'll crack above it. And here comes the rally once again. Therefore, I say, both sides have good arguments, but the bulls have the better one for now. Here's the IWM 30 minutes chart. The laggard of the day, while the SPY and the Qs managed to close at the highs of the day, reclimbing support, the IWM failed in doing so. The IWM failed in reclimbing 183.25. It is consolidating in a bear flag pattern. Now, do you believe that the Russell 2000 is a leading indicator? If you do, it means bad news for the Qs and the SPY. But if you believe that the IWM is just doing its own thing, then have at it. The RSI, the MACD indicators, indicating that the bear flag pattern is not going to play out because we're seeing bottoming in the negative momentum. Yet the pattern remains a bear flag consolidation pattern. It goes out of the window if the chart reclimbs 183.25, it closes the gap, and it continues to march on. Then we can say comfortably the bear flag is done, and higher we go all the way back to 188. What about the Dixie, the dollar index? What's going on here? The negative divergence is still here. Dollar bears remain in charge, but in my opinion, at least for now, the dollar is finding some footing, and the dollar is asking any buyers. I think we're done here. I think I went down enough. Any buyers? If the buyer's not going to step in, the dollar is going to flush down again. It's the same consolidation that you see in the Qs and the SPY. Both charts are now stalling, asking for buyers. The Dixie's also asking for buyers right now. Will the buyers step in to buy the SPY and the Qs, and higher we go in equities, and down we go in the dollar, or will the buyers show up in the dollar instead? We see the Dixie moving higher, SPY and Qs moving down. How do we resolve all of this? How about we zoom in to an hourly chart for the dollar index and look at this. We have a saucer bottoming formation, but look at the end there. It looks like the dollar is spilling over. It's moving down again. If it holds this pattern, the saucer bottoming pattern, then the buyers are going to step in the dollar, not in the SPY and the Qs. But if it spills over, you know the answer. And the confirmation is gold. Gold lost 1,763 for now. Not a major deal. The MACD remains positive, RSI remains positive, but it is a signal that the rally in gold / the rally in equities is running out of gas, and the dollar is looking around for buyers. The dollar says, I'm pretty much done going down here. I'd like to go higher. I'd like to at least a rebound. So for now, gold is waiting and watching what the dollar is going to do next. Gold will let us know right away. If you see the dollar moving higher, how do you know if it's fake or not? Look at gold. If gold is moving down decisively, then it is a legitimate move in the dollar, which means a legitimate pullback in equities. But if you see the dollar down, but gold not going down decisively, it could be a fake out. So watch out for that. Here it is. UK oil, Brent, a daily chart. What's going on here? It lost the trend line, and therefore I issued my warning last night. Oil investors, be careful here. Yes, the stocks are going to hold, but the commodity is going down, at least to 85. This is what it looks like right now. And if it does, there's a high degree of possibility that we could see these stocks also following through and moving down. And therefore, you got to have a hedging strategy. How about the 10-year yield? What's going on here? It caught some footing today. The RSI firmed up a little bit. So is the MACD. But it is still bumping into the resistance. Used to be support. It could not make it today. Could it make it tomorrow? The answer to this question is highly likely. Why do we say that? Look at the TLT, a daily chart. It could not escape the resistance zone. And if it starts to move down, and if the resistance zone proves to be too tough for the chart right now, then the 10-year yield is moving higher. If that's moving higher, equities are moving down. What about the VIX 4 hours chart? What's going on here? Still consolidating at around the support / resistance of 24.29. No definitive conclusion yet. And of course, the bears, the experienced bears at least, are waiting for two things. Number one, the VIX to go all the way down to 20, and for the SPY to reach its 200 days moving average. You put two and two together, it's time to short. But absent of that, it becomes really tricky. It becomes confusing. The easiest way would be VIX 20, SPY pulling back from the 200 days moving average. But the charts are not making it easy for us here. So let's remove all of these markings right here and switch to a line chart. It's still a 4 hours chart, but we're using a line chart instead here. What do we see? A bear flag consolidation pattern, indicating that we could see the VIX down. So we have conflicting messages here. The dollar appears to be finding a footing. So is the 10-year. But the VIX doesn't look good right now, which could excite the bulls. The bulls could say, look at this, the VIX is going down, higher we go. But the bears are also excited because the bears want the VIX to go all the way down to 20 because puts become really cheap and flipping those for profits in the next pullback becomes an easier endeavor. What about Apple? 30 minutes chart. The bear flag played out. We got a gap down, but the buyers went all in right away, buying the dip. They got us above 150 once again. The no entry zone. Every time you get above 150, whack 'em all. Boom, 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 boom. You haven't earned the entry to 150. Give me a piece of data. Give me earnings. Give me something that merits the entry to 150. Otherwise, every time the chart gets above 150, it gets knocked down right away. What about Tesla? The meltdown continues, but it is getting a little bit oversold here. We're looking at the 30 minutes chart now. So could we see at least a oversold rally in Tesla? That is possible. And the VIX, of course, is encouraging. If the VIX goes down, Tesla catches an oversold rally. But then what about the dollar? What about the 10-year yield? Are they also moving down, or are they going to start moving up? We got conflicting messages all over the place. But in this chart, 30 minutes chart of Tesla, look at this. Isn't this a support zone? We got a massive rebound a few days ago from the same support line. Could this hold? Could this produce an oversold rally? I think it's possible. But again, any rally in Tesla is an opportunity to short. And lastly, what about Bitcoin? 4 hours chart. Look at this. We have a consolidation pattern, which happens to be bearish, but we have a break above the consolidation pattern. It is not decisive yet, but it is a welcome sign by market bulls. So market bulls have some supportive evidence here for the rally to continue. Number 1, the VIX. Number 2, Bitcoin. Number 3, the bull flag consolidation patterns all over the place. Number 4, the higher lows that they made in the 30 minutes charts today for the SPY and the Qs. So the bulls have supportive evidence here for the continuation of the bear market rally. What evidence do the bears have that this is stalling and it's about to move down? They got the dollar finding some footing, but we don't have a confirmation yet. They got gold losing some key support, but not decisively. They also got the 10-year rebounding higher, but still not decisively because it failed to recapture the resistance that used to be support. So for now, who has the better argument? Once again, the bulls, at least for now. And therefore, fighting this bear market rally is a little premature for now. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have existing home sales, and most importantly, leading economic indicators. And we also have the new Boston Fed President, Suzanne Collins, who's replacing the insider trader Rosengren. Remember that one? Who got caught insider trading, and then he went, my kidney, I gotta replace that, and retired. So let's hear what she has to say. And with that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. Now we'll talk to you again over the weekend. Take care.
I'm gonna be friends.
Yeah. You wanna be my friend?
I'm gonna